What is an option? An option is a contract that gives you the right to buy or sell a financial product such as stocks, indices, ETFs, bonds, currencies or commodities at a specific price by a specific period of time. What are the benefits of trading options? You only need smaller amount of capital for option trading. Options can be used to create downside risk protection. Generate income on existing stocks in your portfolio. Options have a set time limit, called expiration date. An option time could be as short as a day or as long as a couple of years. Investors trade options when they speculate whether the price will be higher or lower within a certain date in the future, without actually buying the asset at full price. In this video, I will refer the option as a stock option. There are two basic option types: call option and put option. A call option gives you the right to buy an underlying stock at a specified price within a certain time period by the expiration date. A put option is the opposite of a call option. A put option gives you the right to sell it at specified price by the expiration date. When you buy an option, you have the right to buy or sell the underlying stock. If you decide to buy or sell the underlying stock, that's called exercising the option. For example, XYZ stock is currently $150 per share on May 18th. If you buy 100 shares, that will cost you $15,000. You think this stock's price will go up in 1 month. Instead of buying stocks, you buy an option contract. The premium or purchase price for the call option strike price at $150 with expiration date June 16th is $3.75. One option contract typically consists of 100 shares of the underlying stock. Ask price is your buying price and bid price is your selling price. One call contract will cost you only $375 plus broker fee. That means that you have the right to buy the stock at $150 until expiration date. If stock price goes down, you will lose your investment only maximum $375. If you bought 100 stocks at $150 and stock price go down to $125, you will lose $2,500. If it further goes down, you will lose more up to your cost $15,000. Buying call option, you will lose only $375 even though stock price go down to zero. On the other hand, if stock price goes up as you expected, your option value will increase and you can make profit by selling your call option or exercising your option at strike price $150 even though stock price is much more higher than strike price $150. Options are tradable contracts. Most of people don't exercise options. They just trade options before expiration date. If they don't do anything, options will be expired at specific date and may become worthless. When you trade stock, you exchange ownership in a company. When you trade option contracts, you are trading the right to buy or sell the underlying stock. Owning an option does not mean you have ownership in the underlying stock, nor does not entitle the dividend payments. You will not receive any dividend payment for underlying stock because you haven't owned that stock. Option trading has high risk which come with high reward. Much riskier than buying stocks, ETFs or bonds. If you buy stocks and the price fell, you have enough time to sit back and wait for the price to bounce back assuming that company stock has no serious problems. You can make high percentage profit or you can lose your whole investment in option trading because that is associated with limited time frame. Predicting stock price movements can be difficult. If the stock does not go as you expected, you have only limited time frame and your option price will decrease as time gets closer to expiration date. Option trading could expose you to serious losses and you can lose all your option premium cost. An option contract has two main components: strike price and expiration date. A strike price is the price at which you have a right to buy or sell the underlying stock at this price by the expiration date. For example, XYZ stock's current price is $150 on May 18th. You think the price will go up in next 2 months. So you may buy a call option strike price at $150 with expiration date July 21st. That means you have the right to buy XYZ stock at $150 price until July 21st even though the stock price goes up much higher than $150. The stock price can be $160, $170 whatever. You still have the right to buy at $150 till expiration date. If you expect the stock price will drop, you may buy a put option instead of short selling. By buying a put option, you have a right to sell the stock at strike price before expiration date. You can exercise your option at the strike price. For example, XYZ stock current price is $150. You buy a put option at strike price $150 with expiration date July 21st. It will cost you $285 for one contract. If the stock's price drops, your option value will get higher and you can sell the options with profits, or you choose to exercise your option. You could still sell the 100 shares of stock at $150 per share even though current price is much lower than $150. Expiration date. The end date for exercising an option is called the expiration date. Usually options are expired on Friday. There are weekly option, monthly option, and quarterly option. Weekly options expire almost every Friday and are issued on Thursdays. Monthly options expire every month on third Friday of the month. Quarterly options expire on the last business day of each calendar quarter. Following factors affect the option contract price, which is also called premium. Strike price. Options length of time left. Volatility of the underlying stock. The strike price is the major factor determining the option price. In a call option, the contract holder has the right to buy the contract's underlying asset at strike price. Lower the strike price, the higher the call option value. The higher the strike price, the lower the call option value. In a put option, the contract holder has the right to sell the contract's underlying asset at strike price. Higher the strike price, the higher the put option value. The lower the strike price, the lower the put option value. There are three types of strike prices: in the money, at the money, and out of the money strike price. In the money strike prices. In the case of a call option, if the strike price is below the current price, that option is in the money because the owner can exercise the option by buying the underlying stock for less than its current price. In the case of a put option, the strike price is above the current price. The contract holder can exercise the option by selling the underlying stock for higher than its current price. While in the money options are more expensive, they are more likely to maintain their intrinsic value at expiration. At the money strike price means when an option strike price is near where the stock current price is. Out of the money strike prices. In the case of the call option, if the strike price was higher than the stock's current price in the market, that is considered out of the money. For example, the stock's current price is $150. If you buy a call option at strike price higher than $150, that is out of the money. Strike price $155 or $160, etc. are out of the money. In the put option, the strike price is lower than the stock's current price. If you buy a put option, strike price lower than $150 is out of the money. Strike price $145, $140 or so on are out of the money. Another factor determining the option contract price is time frame. Length of time until the contract's expiration date. If an option has longer the time frame left, higher the value. The option price will get lower as time gets shorter. The stock's volatility is another factor which affects on options prices. As volatility increases, the prices of all options on that underlying both calls and puts and at all strike prices will rise. This is because the chances of all options finishing in the money likely increase. Remember, option makers want to make money for themselves. They just want to win and hoping your options end up worthless at the expiration date, so they can keep your option premium. Usually option premium prices are higher when the underlying stock's earning announcement getting closer because the price can move dramatically either way after earning release. Things to consider when you want to trade options. Some statistics show that 95% of the people who trade options lose money. First of all, you have to ask yourself how much can you afford to lose. Option trading has high risk even though come with high reward. You need to pay attention to bid-ask spread. The bid-ask spread of the option is a large percentage of the price of the option being traded. You bought a call option at $7.60 ask price. Bid price is $7.40 at the same time. That means that as soon as you bought a call option, you lost 20 cents $20 for one contract automatically. Also, broker fee and commission fees are much higher percentage for options. Most of brokers charge 65 cents to $1 per contract. Option values decrease with time, also known as time decay. Time decay accelerates as an option's time to expiration gets closer since there's less time to hold for a profit from the trade. What will happen to options at expiration date? If your option is out of the money, it is worthless and you don't have to do anything. For example, you own a call option with strike price $150 and the stock's current price is $145 at expiration. Your option value is zero. You are an owner of a put option which has strike price $150 and stock's current price is $155 at expiration. Your option has no value. Your broker will close out the position which has zero value. If options are in the money, with value 1 cent or more at expiration date, options will be automatically exercised or you can exercise by just minutes before market close. Brokerage firms might have different cutoff time. If your option is in the money at expiration, but your account doesn't have enough money to buy the stock position, your broker may choose not to exercise the option. This is also called as DNE, do not exercise, and any gain of option value will be wiped out. So you need to pay attention when your options get closer to expiration. The contract holder must decide whether to sell, exercise, or let it expire. When an option is in the money, it can be exercised or sold. If you don't have enough money to exercise the options, you better selling your options with profit. If you are a basic call or put option trader, you want the stock price moves significantly up or down depend on call or put options. If stock's price does not move much, your option value will not change much and time decay will kick in. Your option will end up worthless at the expiration date. There are many option trading strategies to make money in any price movement, whether the price is up, down, or no movement. This video is part 1 and different trading strategies will be explained in future videos. Please subscribe my channel for future videos.